Hi, we're moving into Chapter 13, Financial Performance Measurement. So, in this chapter, we are going to describe the objectives and standards of comparison and sources of information in measuring financial performance. We are going to define quality earnings and identify factors that affect quality of earnings. We're going to look at and apply horizontal trend and vertical analysis and ratio analysis to help us analyze financial statements. And then we're going to apply financial ratio analysis in a comprehensive evaluation of a company's financial performance. So let's first look at objective number 1 to describe the objectives and standards of comparison of sources of information that is measuring financial performance. So the foundations of financial performance are financial performance measurement, which is basically financial statement analysis. And in this, what we're going to do is analyze various items in a company's financial statements and relate them together to help us demonstrate whether or not a company has achieved its financial objectives. The two primary groups of users of financial performance measurement are managers and employees within the business at all or at various different levels, and then outside either creditors, investors, or customers. Managers and employees, they're going to look at the financial performance measures and see how the company is doing to help determine where they need to make adjustments within the business's processes or see how the business is doing to help ensure the business is on track for achieving its financial measures, to achieve its financial performance. Creditors, investors, and customers are going to use that to evaluate whether or not, for instance, creditors would lend money, investors would invest money, and customers potentially whether or not they would look to buy the company's products. In particular, with customers, they're going to be looking at it in terms of the longevity of the company and looking to see, is this a company I want to be doing business with for the long term? So as it relates to financial measurement and financial performance measurement, management goals relating to performance measurement include things relating to the financial performance, financial plan, with the following objectives in mind. They're going to be looking at the profitability of the company, and in the performance objective, they're going to look to determine whether or not the company is achieving satisfactory net income. As it relates to the total asset management objective, they're going to look to see if the company is maximizing the use of its assets towards the revenue generation and seeing if the company is using the assets to the best of their ability. They are going to also look at liquidity and determining whether or not the company is able to meet its bills when they're due. Then, as it relates to financial risk, they're going to look at whether or not the company is using debt effectively to limit the company's risk as much as possible and ensure the company's successful future. And they're going to look at the operating asset management, and this is basically whether or not the company is utilizing current assets and current liabilities in ways that support growth of revenues with minimum investment. So who are the internal users of financial performance information? Management is going to use that information for, say, compensation purposes. Oftentimes, managers' performance is dependent upon how the company is doing. So if the company's management team is operating effectively, one would assume that the business is going to perform very well and achieve most of, if not all of, their financial performance targets. under the Sarbanes-Oxley Act of 2002, this is where public corporations and their board of directors had to establish compensation committees so that management wouldn't basically being incentivized to fraudulently or misrepresent the financial performance measures so that they would themselves be compensated, because back in the late 1990s and the early 2000s, where we had some very public financial collapses of large corporations, some of it was attributable to the greed of management and some potentially fraudulent financial reporting activity to help management ensure that it would achieve successful performance thresholds, but maybe not ethically achieving it. So as a result, the Sarbanes-Oxley Act was put into place, and it required compensation committees that provided oversight to ensure that management was operating ethically. And these compensation committees were consisting of independent directors, and they would help determine the top compensation for the top executives. Companies must also disclose the components of compensation for their top management people. They need to outline what the base salary is, as well as any incentive bonuses and or stock options. They also had to provide criteria that would be used in the compensation of their top executives in the documents that are filed with the Securities and Exchange Commission. Some of the external users of financial performance information, as we've learned going back all the way to Chapter 1, are creditors, investors, and they're looking at the financial performance evaluation of the company to judge how the past performance of the company is and how it compares with the present position and future earnings potential of the corporation. The investors' focus is primarily on the potential earnings ability of the company and how that might affect the stock price of that company and any potential for dividends that the company might distribute. Creditors have a slightly different focus, and the different focus for creditors is that they want to know that the company is going to be able to repay any debts that the company has outstanding. In reviewing or trying to determine how a company is achieving these measures, companies use some standards of comparison. One of the standards of comparison is the rule of thumb measure, and these provide general guidelines. So for instance, and you've heard me talk about them in class, generally speaking, when we're talking about the debt of the company, we're going to look at the current debt to tangible net worth, and we want it to be less than 80%. With regard to inventory to net working capital, again, we want it to be less than 80%. So these are just general rules of thumb for companies to follow. We're also going to use what we call past performance standards of comparison, and we're going to look at the company over time. How is their current performance comparing to their past performance over time? And then we're going to look at industry norms and compare our company to similar types of companies. This gets a little bit more complicated when we're looking at diversified companies that we might call a conglomerate, where they maybe operate in different industry segments, and you can't really easily compare them to one other like competitor because they maybe operate and have really several different types of competitors. So some limitations to using industry norms would be that no two companies are really exactly the same. So So while we can say that Target and Walmart are similar companies, they're not exactly the same. They're both discount department stores, but they don't operate exactly the same. They don't target the same exact markets, and they don't provide the exact same types of goods and services to their customers. Another limitation of using industry norms, as we mentioned, is diversified companies or conglomerates, because they're different business segments may be operating in unrelated industries. So making comparisons to other conglomerates would be very difficult. And then third limitation is that different companies often use different but equally acceptable accounting procedures for recording similar types of items. And so the ways that they report their report things in their financial statements may look different and therefore make them not truly comparable. So as investors or creditors or people outside of an organization, how do we find out information about our public companies? So one way that we find out information is through reports that the company itself would publish. Things like their annual reports or the interim financial statements that they publish are a very good source of information about the company. A second type of information would be the reports that they have to file with the Securities and Exchange Commission. These would include the annual reports in the form of the 10K, quarterly reports in the form of a 10Q, and current reports in the form of what we call 8Ks. There are also a whole host of other different types of reports that companies have to file with the Securities and Exchange Commission that are also equally informative on different aspects of the business's organization and financial operations. And then third, there are outside periodicals and credit and investment advisory services. So some of these I am trying to get you guys in the habit of looking at by having you look into stock industry reports, the industry reports that we've referred to utilizing our library database, the market analyst reports that you can find out on the internet, a whole host of different periodicals, the Wall Street Journal, Barron's, MSN Finance, Business Week, all sorts of different business periodicals and credit and investment organizations that provide these publications that follow and track the publicly traded companies. I'm sorry, I keep getting the track team keeps running through as I'm talking. And so this is our stop and apply for the learning objective number 1. You guys can certainly take a few minutes and try to answer some of these questions. In the spirit of time, I'm going to move to learning objective number 2, which is looking at the quality of earnings and identifying factors that affect the quality of earnings. So how do we evaluate the quality of earnings? Well, first of all, we want to look at and explore what the substance of the earnings is for a company and how sustainable they are in future accounting periods. Some of the sustainability goes into things that we've discussed in the past. We want to look at how much the business is generating in terms of their profits as it relates to their ongoing daily business activity. We certainly want to know that they're operating profitably, that their net income is not really being largely derived from non-operating or other income as a source of their primary profitability. Some of this can be affected by the different accounting methods that a business uses, as well as accounting estimates, and like I said, one-time items. The more profitable a company is as it relates to one-time items, those are things that you have to look at sort of on the side as kind of like a bonus or detriment, because you can certainly have one-time items that are large expenditures for a business as well. So you have to look at them and find out and understand what they are, and will they continue to happen, or is it an isolated instance? Then, in terms of evaluating the quality of earnings, we want to look at what accounting methods are acceptable and what the impact of those methods are. And we will be exploring more of these methods in future chapters. So for instance, how is the income of the company affected by using the inventory method called LIFO versus using a different inventory method? So for instance, LIFO is going to lower the operating income during an inflationary period because of a higher cost. It's going to result in a higher cost of goods sold. In addition, you have the double declining balance method of depreciation of our assets. This results in a lower operating income in the early years of the depreciation of an asset because we have higher depreciation expense in those earlier years. Therefore, the higher depreciation expense results in a lower operating income. We also want to look at what are the cash flow impacts of certain accounting methods. How does it impact the taxes, and when are those taxes paid? How do the impacts on the estimated useful lives of an asset impact the cash flows? And then we're also going to look at the financial statements and the interpretation of this data on the financial statements. Secondly, in terms of evaluating the quality of earnings, we're going to look at accounting estimates. So for instance, evaluating the estimate of long-term assets' useful life. Not always easy to do, but something that needs to be done in order to make your depreciation calculations. And again, lastly, we're going to look at one-time items, such as gains or losses and or write-downs. Write-down, as we've talked about a couple of times, is just a reduction in the value of an item, an asset, to reduce it below its carrying value on the balance sheet. So, for instance, we've talked about it with regard to inventory. If you purchased an item into inventory and then the market value, what you can currently sell it for today, is less than what you purchased it for, you need to write the value of that asset, that inventory asset, down to what the current market value is, so that you're not carrying it at a higher level than you can actually sell it for. Additionally, if you have restructuring that you have to do within your business, suppose you close an operational component of your business, you need to estimate the cost of that change in your operations and how much it's going to affect you, and any layoffs and any costs associated with layoffs. So you need to estimate those items as well. So, you know, those restructuring charges, and then also if you're going to discontinue operations, you may have to do adjustments relating to the discontinuation of operations. So this just kind of gives you a little quick snapshot of some impacts associated with an income statement for a business, and operating items, income tax items, non-operating items, and how this information might affect the earnings per share of a corporation. So just is giving you like a quick snapshot of an income statement and how the different factors can affect it. And then here we have our second stop and apply, and I'll let you guys look at this and we can discuss it a little bit more in class next week.